So in this segment, we'll discuss economic nationalism as well as the more recent modification, hegemonic stability theory. And, in economic nationalism, this actually is something that started before liberalism, before Adam Smith came along. Many countries in Europe were engaged in something called mercantilism. And essentially what this was is governments saw the world at that time as a zero-sum game. They saw that, they were competing with other countries within Europe, and they felt that they had to pursue their own national interests. And they were very concerned that trade could actually weaken them, because at that time, people used gold and silver to pay for any goods. And so countries felt that if there was too much trade, if their citizens were buying too many things from other countries, that would deplete the supply of gold. It would flow out of their countries, and there wouldn't be enough gold and silver in that country to engage in wars or to protect themselves if needed. So there was really this zero-sum mentality. And so the early mercantilist ideas were very, the idea of protectionist is not engaging with trade with one another, looking out for your own self-interest. And in the 20th century, some of these ideas, actually they had gone back to ancient Greek times, but they were developed in more theoretical fashion, in much more depth. In the 20th century, the ideas of political realism. And these are the ideas that countries really needed to look out for their own national interests, to think what would be serve their own benefit, even if that was detrimental to other countries. That the most important thing was to look out for the national interests of their own nation. And so this approach, is kind of how we would think of this economic nationalism. We're looking at economic nationalism looks at this from the economic standpoint, what governments need to do to protect their national interest. And so way back in the founding of the United States, which is pretty unusual, pretty ironic, given that the United States, often, or at least until recently, has often espoused liberal views and liberal ideas. But at the founding of the United States, there was this notion that really the United States, if it wanted to become an important economy in the global economy, if it wanted to be an important power, it needed to do more than just export cotton and wheat and agricultural goods, which it was doing back in the 1700s. And what this new nation needed to do was actually move into the development of manufacturing industries. And so Alexander Hamilton, one of the founding fathers of the United States, issued this report on manufacturers that he presented to the U.S. Congress, which basically said that if the United States wanted to develop its economy, the government would have to take an active role and impose taxes on imports, tariffs on imports, on manufactured goods, for example, things like clothing, so that the United States, instead of just producing cotton and exporting the cotton to Europe and then having Europe manufacture clothing and export it back to the United States would actually begin manufacturing its own clothing. Because the high taxes on imports, these import barriers, would make it so difficult, so expensive for people to buy imported goods that they would start to buy locally produced clothing instead. And that would spur on the development of manufacturing. And so this was one of the original ideas way back at the founding of the United States. Economic nationalist ideas were being proposed, this kind of activist role for the government to promote the national interests of the country. There was a German economist who proposed similar kinds of things. Friedrich List in Germany proposed similar ideas. And so I think the idea of the economic nationalist is this is a very common practice that of people that uphold or adhere to this economic nationalist idea, something called import substitution industrialization. And that is a mouthful. So many people just refer to this practice as ISI. And essentially what ISI is to block access to the domestic market so that local companies can begin to manufacture products that previously had been imported. So you see that people begin to substitute locally made products. They begin to buy locally made products instead of buying imported products. And that substitution of locally made products in place of imported products, that import substitution results in the industrialization of the country. because now your manufacturing industries are being supported by all these domestic purchases. It's just too expensive with these high taxes on imports, too expensive to buy the imported products, and so you buy locally. And so that is an economic nationalist idea. That is government intervention in the capitalist economy to promote local development. And so that is, in its essence, that's what economic nationalism is. So now keep in mind that this is in the context of a capitalist system. Economic nationalists don't have any problem with capitalism. They just want capitalism that, with the proper government intervention, promotes the national interest of the country. Do you see? So that's a little bit different. That's not a structuralist idea. This is still capitalism, but government intervention to promote the national interests of the country and that country's industries and so on. So many economic nationalists would point to other kinds of strategies. They would say government intervention to promote exports might also promote the national interests. And you could imagine certain kinds of government policies that might promote those kinds of exports. There are certain kind of tax incentives and things that promote exports, and that's government intervention to promote the national interest. Here's another example of a significant government intervention that would promote the national interest, at least economic nationalists would argue, of a country's economy, and that is intentionally devaluing a country's currency. And if you think about it, currencies are bought and sold on currency markets. There's a whole international market in buying and selling currencies. And so what's interesting is governments, which produce these currencies, if they want to, they can just print more of their own local currency. And by increasing the supply in the global currency markets of a particular currency, that increased supply lowers the value of that currency. And think about that. So that means that products that are produced in that country and are priced in terms of that currency now are cheaper, right? If a country holds a different currency, U.S. dollars, for example, and it's the U.S. economy, had a stable currency, the U.S. dollar, and some other country has dramatically increased the supply of its own currency, products from that country are going to be priced in terms of this currency. Now you don't need as many dollars, right, to buy the product. And so I think the product seems cheaper relative to other countries' products. And so, in other words, it's going to be much easier for that country to export its products. And so often we will see governments intentionally manipulating their exchange rates in this way, interfering with the market forces, purposely to give themselves an advantage and give their industries an advantage in exporting their products. And subsidies, government financial support to national firms, support for national research and development efforts, all of these things are government intervention in the economy to promote the national interests of the country. So ISI, that protectionist policy to promote domestic industries, that's one approach, that's one economic nationalist approach, but obviously there are many other things governments can do to interfere with the markets and promote their own national interests, but of course, still within the capitalist context. And again, economic nationalists, no problem with capitalism. They just want the government to intervene to promote their country's national interests. So I think you can see that this is very different from the liberal view that says we're all can benefit. We can all prosper. Free trade, minimal government intervention actually promotes the interests of all nations and all companies, and it's a win-win. Economic nationalists see things differently. Now, one of the things that economic nationalists often refer to is this kind of chart. Now, I'm hoping you can see this chart easily. And basically what this is showing is this concept of declining terms of trade for commodities. And by commodities in this context, what I'm referring to are products that are not manufactured, that they have no value added to them in the production process. There are things like just copper, just raw materials. Think of commodities in this context as raw materials. Things that are just pulled out of the ground or just plucked from the tree, coconuts, for example, bananas would be commodities, right? And so there's nothing to differentiate them. They are just generic, standard, no value added. They're just raw materials, right? And so what we have noticed, or what economists have noticed, they've gathered data on this, is that they have noticed that over time, a country that just exports commodities, let's say bananas or coconuts, and imports manufactured goods, will tend to run into a trade deficit because the prices for commodities over time tend, generally speaking, to decline relative to the prices for manufactured goods. And there could be all kinds of reasons for this. Perhaps, there's so many other uses for manufactured goods compared to commodities. Think of this. With bananas, you can sell only so many bananas, and then the market is saturated, right? People say, I have enough bananas. And that's pretty much, you can't really use bananas for many things, maybe make banana chips or something. But with something like manufactured goods, right, there almost seems to be, in some cases, an unlimited demand for things like Apple iPhones or those kinds of things. So what is interesting is that they can command over time a higher price relative to commodities. So there has been this phenomenon that has been, confirmed with data, and this data was gathered by the International Monetary Fund itself that said, over time, countries that export commodities, the prices for those commodities tend to decline, except in some instances where there's a sudden surge in commodity prices. And if you notice, approximately the timeline here, when you're looking at this yellow line against this nice bars, which are just meant to provide a contrast, the green bars provide a contrast for the yellow line, there can be a surge. And the surge in commodity prices could result from sudden increase in demand. So in World War II, around the time we see that first surge, you saw this sudden increase in demand for raw materials, for things like iron ore to make weapons and cotton to make uniforms. And so there's a sudden surge in commodity prices, but it's a short-term phenomenon because then the long-term decline in commodity prices relative to manufactured goods goes down again. Until, let's say, in the early 2000s, we saw another surge in commodity prices as China and India were industrializing very rapidly. They needed a lot of these raw materials to do that. But now we're seeing the decline in commodity prices again. So the bottom line is that if you're a country that just exports bananas and you import manufactured goods, you likely are going to have a deficit, a big deficit in your trade balance, and that economically, as we'll see later, can hurt you economically. And so what economic nationalists said because of all of this and noticing this, they said, well, okay, our solution is this. Let's block imports of manufactured goods. Let's use ISI, import substitution industrialization, purposely putting up high taxes on imports to keep out the manufactured goods so we can start to develop our own manufacturing industries. We'll put up protectionist policies, keeping out the imported goods because of these high taxes. And those imported products will now be so expensive for our local customers, they'll be willing to buy locally made manufactured goods, even if they aren't the same quality or the same efficiency. And that will begin developing new industries. And so this kind of activist government intervention, many economic nationalists believe, is the proper approach to promote economic development. So you see, at the very beginning of this course, I mentioned an example of the Brazilian government imposing really strict restrictions on imports of personal computers. And their idea was to develop their own personal computer industry, right? Their idea was that that would promote their own industry. Now, in most cases, including that one, this approach doesn't work. Economic nationalism results in disastrous outcomes, right? People only have access to locally made goods, which are much lower quality, higher cost than imported products. And so it stagnates the economy of that country. And that's what happened in the case of Brazil, until finally the protectionist barriers were lifted in the 1990s, and Brazil's economy, allowed to engage in freer trade in that industry. So many countries find that this approach doesn't result in good outcomes, but many economic nationalists would point to the success of some countries, such as Japan, which used this approach. They would have a 5-year plan and purposely keep out imports of steel until they developed their own steel industries. And then they would move into automobiles and purposely block imports of automobiles until they developed their own automobile industry. And then eventually they were able to become an economic power using this kind of economic nationalist approach. China, intentionally keeping its currency undervalued for so many years, they've allowed it to float and meet increase in value recently, but China for decades had very low, intentionally low, undervalued exchange rate to boost its own exports and promote its economic growth. So China is notorious for using these kind of economic nationalist policies. And so some economic nationalists in the United States would say the proper approach for the United States would be to respond in kind, to retaliate by imposing our own tariffs, putting in our own economic nationalist policies. Liberals, of course, would disagree and would say that approach will not work. So again, there are different views of the world on this, right? So if we wanted to summarize the economic nationalist view, the main tenets of this view, right, would be that the major actors are not individuals and not classes, as the structuralists would say. The major actors are governments, or as I use the term, states. And the goal of these governments is to promote their own national interests. And the role of these governments is definitely in the economy, right? Is definitely going to be interventionist. They're going to interfere with market forces, but within a capitalist context. They're fine with capitalism as long as that capitalist economy is promoting their own industries and promoting their own interests. And again, this isn't the interest of any specific group or class within the country, but the overall national interest of the country. And of course, trade relations in a country that adheres to this kind of worldview is going to be conflictual. There's going to be, plenty of trade disputes and conflicts and trade wars that go on. But economic nationalists would say that's inevitable. That's how things work. That's the way the world should work. Okay? And so that sums up the economic nationalist view. But now I'm going to tell you about the more recent version of this, the recent modification of this, and that's hegemonic stability theory.